Okay guys, we have already started the IFRS 15 about revenue, and we have started the 5-step model regarding the revenue recognition. We have already studied the first two steps, that is the identification of the contract, and then we have already studied the identification of contract and then identify performance obligation. Then we have already discussed in more detail that when the revenue from the contract will be recognized, when the 4 criteria are met, then you have to recognize the revenue. Then we have also discussed in detail that how to identify the separate performance obligation. Then we have already discussed that there's good or services that may be distinct or may not be distinct. So when you have distinct good and service, and then you have to recognize the revenue for that performance obligation. Now in today's lecture we will discuss in more detail about determining the transaction prices, which is the step number 3. So transaction price is actually the amount of consideration the entity expect to receive in exchange for satisfying its performance obligation. So when the entity satisfying the PO, then they will expect the amount of consideration, and that consideration we call the transaction price for the contract. And we have already discussed that sales tax should be excluded from the transaction prices. Fine. Now when you are considering transaction price, then you have to count the key factor that you need to consider. The first one is variable consideration. Then you have also to consider the significant financing component, then non-cash consideration, and then consideration payable to the customer. So what does we mean by the variable consideration? If the prices depend on the future outcome, mean there is no fixed consideration, then it will be called variable consideration. For example, discount, rebates, performance bonuses. So the entity must estimate the variable amount, and the estimate is included in the transaction prices. Okay, once it means that variable consideration will only be included in the transaction prices if it is highly probable that there will not be significant reversal when uncertainty is resolved. So there is there's a higher the transaction price in the estimate is highly probable that will not be reversed. And then you have significant financing components that adjust the price if the payment term creates significant time differences. For example, advance payment or deferred payment were long term, so revenue reflect the present value of the expected consideration. Then you have non-cash consideration. If the payment made in goods or services or non-cash item, the transaction price is based on the fair value of the non-cash consideration. Then the fourth one is consideration payable to customers. Entity payback a portion of consideration like rebates or incentive that will reduce the transaction prices by the payable amount. Now let's discuss in more detail that what is variable consideration and how you will counter the variable consideration, and then you will include this variable consideration in your transaction prices. For example, a company agreed to sell goods for $1,000, okay, plus a performance bonus of 200 if delivery is made on time. The company estimated that 90% of likelihood of meeting the deadline. So this is the deadline that the company will pay, agree to sell the good. Okay, this is the fixed amount, and performance bonuses of 100 if the delivery is made on time. So expected transaction price is fixed amount, that is 1000, and then variable amount which is $200, and there is 90% likelihood of meeting the deadline. So you will count as 180. So total transaction price will be this amount. But whenever it is highly probable that the 180 will not be reversed. Clear? Now we have example here, and this example I have just I took this example from the from the Kaplan kit. You see here first the requirement: discuss accounting treatment of the above and the Bristow financial statement for the year in 31st December 2001. If B has experience of providing identical services in the past and it is highly probable, so it means that it is highly probable. Wait, let me change the you see, company has high experience of this sort of product in the past, and it's highly probable that the number of mistakes, so this is the condition, will not fall below the acceptable threshold. And another one is the opposite one, that is no experience, and this services, it's unsure that the number of mistakes made will fall below the threshold. Okay, now on 1st December 2001, okay, your accounting year is to 31st December 2001. So on 31st December, Bristow provides services to customer for next 12 months. Clear? Now the consideration is 12 million, and B is entitled to an extra 3 million if after 12 months the number of mistakes made fall below the certain threshold. So in one case you have option number one, the answer, question number one, the requirement number one. It says that Ed has experience, and this is probably high probability that they will just Bristow will meet the deadline, the target, and definitely they will get the extra 3 million. And the second, they don't have, there's no probability, and they are unsure if the number of mistakes may fall. So what you will do with that sort of question? So here, let me answer this. Okay, first thing, let me use another here. This is the requirement number one. Okay, on 1st December, Bristow provide the services to customer and for the 12 months. So the fixed consideration, is 12 million. Clear? And then the second is variable consideration, and the variable consideration is 3 million. Okay, now this 3 million depended on meeting performance threshold, so it is depended on performance threshold. Clear? So when you meet the threshold, then definitely this will be included and as a part of transaction cost. If not, then you will not consider this. Clear? And the third step, then you have to recognize revenue recognition. And the revenue recognition is over time because this is for the next 12 months. As the service is provided for 12 months, so it will be over time. Okay, now first what you will do, you will estimate the variable consideration. So the most you have two options, it may be 0 or 3 million, and the most likely amount is $3 million because it's highly probable. So the target will be likely to be achieved. Okay, this is the estimate. It will be called variable consideration. Clear? Okay. So the transaction price prices will be, your fixed consideration, that is 12 million, plus your variable consideration. And why we count this variable consideration as a part of transaction cost, because it is highly probable. So this will be the 3 million because it's highly probable that based on the past experience. And the total transaction cost, price will be 15 million. Now after calculating transaction price, you have to recognize revenue recognition. So recognize 1/12 of the total price, because the service is provided over 12 months and the revenue should be recognized for the December 2001. So you will revenue for December 2001 will be 15 million multiplied by 1/12, and you will have 1.25 million. This will be for the year one, which is only 1 month. Clear? So we have just done this question. Okay, here this one, part 1, and we have recognized the revenue for the December 2001, and the year it is 31st December, so it will be only 1 month, and we have calculated the 15 multiplied by 12, and you will get 125 million. Now if this B have no experience and it's not sure about the number of mistakes made will fall below the threshold, then how you will count this? Again, let me show you here. Okay, here. Now the first thing you will do is estimate. This is the part B. Estimates variable consideration, and there is no probability consideration, so you should not include, cannot include this 3 million variable consideration and the transaction price, and the reason is it is not highly probable that there will be no significant reversal. Then after that you have to calculate the transaction price, and the transaction price is number one, fixed consideration, and that is 12 million. Variable consideration, which we have estimated as 0 because there's no probabilities, it's not highly probable. And then the total transaction price will be 12 million. Now the third step is revenue recognition. And that recognize 1/12 of the total price. So revenue for December 2001, 12 million multiplied by 1/12, and you will have 1 million for the year. So this means the first scenario was highly probability of meeting the target. The first scenario was highly probability of meeting the target, and the second was uncertainty due to no experience. Clear? So the transaction price with a high probability will be 15 million, and the transaction prices with uncertainty due to unknown experience will be 12 million, and revenue recognition for 1 month, and that is the 31st December, it will be 1.2 million, and here it will be $1 million. So this is just the solution of the first question. Clear? Now, if you have a sales with a right to return, then how you will deal with this sort of scenario when you sell and there's a right of return? So variable consideration, the consideration for the sale is variable because the customer might return the product. So this means there's a variable consideration, and the entity must estimate the variable consideration to determine the transaction. So when you have to count part the variable consideration and the transaction prices, we have already discussed that if there is highly probability, then we will count the variable consideration as a part of the transaction price. Otherwise, we will not include that in the transaction price. Now, transaction price only include the amount of consideration that entity expect to keep, mean based on estimated return. So first you will check for the variable consideration, then you have to count the transaction part, calculate the transaction prices, then definitely you have save the right of return. So there will be the refund liability. You have to consider that the refund liability must be recognized for the portion of the consideration that the entity does not expected to be entitled to. So this is the expected return, and then you will also adjust for the inventory, mean the product expected to be returned or recognized as an asset representing the entity right to recover the goods recorded separately from the entity. So we have just to first from these 4 steps when you have scenario like sale with right of return. Clear? Okay, you see here we have example. Let's say we are selling a product for $100. We have a sale of $100 and expected returns of 10%, which means that you have expectation of $10,000 return. So what you will do, recognize revenue for the amount expected to keep, and you will definitely keep the 90 because this is your refund liability. So you will say like 100,000 less this amount, and your recognized revenue will be 90. Now refund liability, record the refund liability for expected return, that is $10,000. And then right to recover inventory, definitely you are selling the asset. Then if the customer returning, then you have to recognize that is an asset for the good expected to be returned at cost. So you are recognize the asset at the time when it's refunded, then it will be at cost. Okay, let's do some example here. Here's example. Okay, how should the above transaction be recorded for? This is an enter into 50 contracts with a customer. Good. This is a total number of contracts is 50. Each contract includes sale of one product of 1000. The cost for N of each product is 400, and cash is received upfront and control of the product transfer on delivery. Okay, and customer can return the product within the 30 days fine to receive the full refund. Okay, now N can sell the return product at a profit. There's significant experience in estimating return for this product, and estimated that 48 product will not be returned. So it means that you have to recognize the need for only 48 products. So the total products, let me do it here. So the contract detail was, let me write here, contract details. The contract detail was, these were 50 contract. Okay, and these contract was sold at $1,000 each. Then you have cost per product, or you can say per contract, was 400. Let me check it. Yes, you see here 400 cost, and then the customer can return products within 30 days. And here we have the probability that 48 will not be returned. So this is the contract detail. Now we have the return details, and that is that 48 product will not return, will not be returned, and 2 product expected to be returned, Now we have to do how the above transaction should be accounted for Okay, the first one is variable consideration. There is return option, so it means this variable consideration. Means there's a right of return, so the consideration is variable. Right of return means the consideration is variable. Okay, now estimated revenue. Estimated revenue, based on the inexperience, that 48 multiplied with 100, you will have 48,000. This is the estimated revenue, which is highly probable to be retained without significant reversal. And then you have refund liability, and recognize liability for the expected return, that is 2 multiplied by $1,000, then you will have 2,000, and this is your refund liability. Clear? Okay, the third step is you have to do some adjustment for the inventory adjustment. And first you have to derecognize the inventory already transferred to the customer, and that is 48 sold product multiplied with cost 400, so it will be 9,200. So this is the derecognition of the inventory transfer. Clear? Now you have to recognize a return product, and I discussed that will be on cost. So it is expected that return will be 2 products, so 2 multiplied with the cost 400, and it will be $800. So this is your inventory adjustment. Clear? What will be your journal entry? Journal entry, at sale, first at sale you will have debit cash 50,000, then credit revenue with 48,000, and then credit your 2 product liability, that is called refund liability with 2,000. Okay, now cost of sale. For cost of sale, what you will do? Debit cost of sale with 9,200, credit inventory with the same amount, and then about return asset that you will recognize. So debit return asset inventory, and credit will be your cost of sale adjustment, and that is 800. Clear? So what we did in this question is about when there is when you are doing a transaction with the right to write up return, then first you will do revenue recognition, how you will do estimated revenue recognition, then the refund liability, then right to recover inventory. Clear? Here is the fourth step you have to follow. First you have to work on the variable consideration, then you have to calculate transaction prices, then the refund liability, mean the right of returns, the recognition of the asset which is going to be returned, and then inventory adjustment. You have also to recognize those. So and the question what we did, we have recognized revenue with 48,000. We have also recognized the refund liability of 2,000. We have de-recognized the inventory with 9,200, and then we have also recognized return asset with 800. And this question is all about that. Clear? Okay. Now here we have another concept which is also related to the transaction cost, that you have to count the transaction financing, that we call this financing component. Financing component and the transaction cost. So financing component exists when there is significant time gap between the transfer of goods and services and payment. So when there is a difference, significance, time gap between the transfer of goods and services and payment. Let's say you are the transfer good happen at 31st December, and the payment will be paid at June 2002. Then there is significant time gap, and this means that there is financing component. Clear? Okay. So the entity mean the seller or the customer receive the financing benefit. So any either the seller or the customer receive the financing benefit. Clear? Now indicator of financing component, how you will indicate that there is significant financing figure. The first one is price differences. The promised consideration differs significantly from the cash selling prices. Time gap, the long period exists between the transfer and goods and services. So there are two indicators that will suggest you that there is significant finance component. The first one is price differences and the second is time gap. So when the promised consideration is different from the cash selling price, then it means that there is significant financing component. And if there is a difference between the time of transferring the goods and services and the payment, so it means there is significant financing component. Then you will do adjusting the transaction price. If significant financing component is present, the consideration should be discounted to its present value, and the usual customer borrowing rate at the discount rate. So it means that you have to adjust the transaction prices for the significant financing component, and what you will do, the consideration should be discounted to present value, and for that you will use the customer borrowing rate as a discount rate. Clear? Okay, initial recognition will be, revenue is recognized at the discounted present value. So definitely that will be discounted present value. The consideration should be discounted to present value, and the discounting factor which we use will be the borrowing rate. Now interest recognition, interest income or expense is recognized over time at account of following financing component. Okay. let's say we have example here for better understanding. The customer agree to pay 1000 for product, but the payment will be made 2 years later. So it means there is a time gap of 2 years, which indicate that there is significant financing component. Clear? And the customer borrowing rate is 5% per annum. So this 5% will be used to discount the consideration to fair present value, and the consideration is 1000. So discount the payment means the present value of the 1000 will be this amount, revenue recognized initially at this amount. Now interest over time, so recognize interest income, this one will be recognized in the year 1, you see here, and then interest income about 47.62 for the year 2. Okay, if you see here account receivable, this is the account receivable mean asset, and this is your revenue, and this is your deferred interest income. And then the deferred interest income debit, credit interest income. So this is the general entries. Clear? Now we have example. Let's do this example, then you understand in a better way. Here are entry into a contract. Okay, first you just read the explain how this transaction should be accounted for the financial statement of all for the year 31st December 2001. Here are entered into a contract with a customer fine to sell equipment on 31st December 2001. Year end is also 31st December, and the control of the equipment transferred to the customer on their day. So on the 31st December 2001, the control of the equipment is transferred. Now the price stated in the contract is 1 million and is due on 31st December 2003. So market rate of interest available to this particular customer is this one. Okay, so let me explain this here. Okay, here. Okay, what the transaction date? First you have to write the transaction date was 31st December 2001. Clear? Now payment due date is 31st December 2003. It means 2 years later. Clear? Okay, the contract price was given $1 million, and then customer borrowing rate is 10%. Accounting treatment, we have to do the accounting treatment. So the first one is, let me write significant financing component. So a significant financing component exists due to the 2-year gap between the transfer of the control and the payment. Okay, and then the contract price must be discounted to present value, and you have to use the 10% customer borrowing rate. Clear? So what will be the present value of consideration? So $1 million at the rate of 10% for 2 years. Okay, so if I write like this, $1 million, 1 plus this one, this is the discount for annuity factor, then your amount will be 26.446. okay, this is your present value for 1 million. Now you have to recognize this recognition on the recognition on 31st December 2001. So the revenue recognized will be 26446 when the performance obligation is satisfied. So when the performance obligation is satisfied, then you have to recognize this amount, and you have to record a receivable for the same amount. For subsequent year, for the subsequent years, what do? You have just to recognize the interest income, recognition, or recording of interest. So receivable accounted, definitely receivable you will account it for the IFRS 9 financial instrument, and the interest income is recognized annually. Okay, if you are recognizing like for year 1, this is 26446. By year 1, let's say we means this is 2001, so it will be 2002, and that will be your amount multiplied with 10%, so you will get this amount. You can also check by yourself. Okay, this is the first recognition of interest income, and then for second year do the same. Clear? Okay, so in this question you have seen that the price is stated in the contract, this one, and is due to 31st December, so there is 2 years of gap, which means there is a financing component, and that should be considered in the transaction prices. Clear? So what you will do, you will just do in a very simple way. First you have first you have to understand that is there any financing component. If yes, then there is indicator. You have to follow the indicator, and then you will understand this financing component. Once you find that this is a financing component, then adjusting the transaction price should be adjusted, and for that you have to discount the consideration to present value, and for that discounted rate is used to be the customer borrowing rate. Initially, recognize initial recognition will be revenue, will be discounting present value of the consideration, and then interest recognition will also be income or expense should be recognized over time. And for that we have already done the question, and this is just the simple example, and then we have already done the example from the kit. Clear? Now let's move on the third factor. The third factor which should be considered regarding the revenue recognition, the transaction prices. So that is called non-cash consideration. Non-cash consideration definition should be like this: that any goods or services or other asset received, it may be share also, an exchange for providing goods services rather than cash. So when you are providing, mean the consideration is not in the form of cash, it may be in the form of goods, services or share, then we call that as non-cash consideration. Non-cash consideration must be measured at fair value, should be measured at fair value. Fine. So if the fair value of the non-cash cannot be reliably estimated, then a transaction is measured using stand-alone selling prices of the promised good or services to the customer. So when the fair value is not reliably measured, then you have to use the stand-alone selling prices of the promised good or services to the customer. Okay, the key point here is that the fair value is the amount for which the asset could be exchanged or the liability is settled between the knowledgeable or willing parties in arm's length transaction. This is the definition of the fair value, that it is the amount for the asset that could be exchanged or the liability that could be settled between knowledgeable or willing parties and arm's length transaction. So if the fair value cannot be determined, then the stand-alone selling prices of the goods or services will be used. By stand-alone selling prices is we mean that the price at which the entity would sell the goods or services separately to the customer. Clear? Now here we have example. See how much revenue should be recognized from this transaction in the financial statement obtained for the year 31st December 2001. So here is the example. Dan sold goods to Stan. The control of the good was transferred on the 1st January 2001, and we are counting for the 31st December 2001. So on 1st January, the transfer of the good, the control of the goods service was transferred, and the consideration received by Dan was 1,000 share and Stan with a fair value for each. By the 31st December 2001, the share of Stan had fair value this amount. So this means that this is a non-cash consideration, because the good or services or other asset which is share, okay, is received and exchange for the goods and services rather than cash. So the consideration received is 1,000 share. This means that this is non-cash consideration, and this non-consideration should be measured at fair value. And the fair value is not measured reliably, then you have to use the stand-alone selling prices of the promised goods or services to the customer. So in this example, first what you will do, let me write here. First what you see the transaction detail. Good sold to Stan, okay, and the control transfer on 1st 2001. Clear? Now consideration received from Stan by the Dan was 1,000 share and Stan. Clear? Now fair value of the Stan share on 1st January 2001 is $4 per share, and then they also mentioned that fair value on 31st December 2000 will be 5 per share. This is the transaction detail which I have written just from here. You see here, good transfer on the 1st January. Consideration received 1000 share. Fair value this one and this one. Clear? Now how you will recognize, because how much of revenue should be recognized from this transaction. So this is very simple. The first thing is, the transaction involves a single performance obligation, that is sales of goods. Okay. Then there is non-cash consideration, and that is the consideration received by the den is non-cash, and that is share and stand. So this means non-cash consideration. Clear? Now the non-cash consideration should be measured at fair value at the time of transfer. At the time of transfer. Clear? Now the revenue to be recognized on 1st January 2001 will be 1000 share, and the share price on that date is $4 per share. So if you multiply this, then you will have this amount, 4000, as the on 1st January 2001, when the control over the good is transferred, the fair value of the share is $4 per share. So the 1000 multiplied by 4, you will get 4000. Clear? So revenue is recognized 4000 based on the fair value of the share at the time of transfer. Clear? Now subsequent changes in fair value, and about that we know that the change in the fair value should be counted for under IFRS 9 financial instrument, and that is not a part of revenue. So any subsequent change in the fair value of the share from $4 to $5 by December 2001 is not included in the revenue recognition and should be treated under IFRS 9 financial instrument. Clear? So the revenue recognized for the year ending 31st December 2001 will be $4,000, and subsequent fair value change will be increasing to the from $4 to $5 should be recorded as a change in the value of the financial instrument that will be treated under IFRS 9 but not included in the revenue. Clear? Now let's move on. We have another concept, and this is the last one, I think. What the hell? And that is consideration payable to customer. Okay, so consideration payable to customer, we mean that any payment or value given by entity to the customer as a part of contract, then we call that as consideration payable to customer. So if the entity pay anything, any payment or value given by the entity to customer is a part of contract, then that will be the consideration payable to customer. So this could occur in the form of cash. It may be cash, discount, or other benefit provided to customer. The accounting treatment: if the consideration is paid to customer in exchange for distinct goods and services, and if consideration paid to customer but not an exchange for distinct goods and services, then how you will treat it? Okay, if the consideration payable to customer for distinct good, then how you will treat it? And if the consideration is paid to customer but not an exchange for the distinct good, then how you will treat that? So if the consideration paid to a customer in exchange for distinct goods and services, then the payment should be accounted for as a purchase transaction. If you are paying the consideration to the customer as a part of contract, and that is for the distinct goods and services, then that will be considered as a purchase transaction. This means that it is treated like a cost of acquiring the goods or services from the customer. Now, if the consideration paid to customer is not an exchange for the distinct goods and services, then that should be reduction of the transaction price should be deducted from the transaction price. This means that decrease in the amount of revenue is recognized from the contract with the customer. Clear? So the summary of this factor is that if the purchase consideration and reduction of transaction prices. So if the payment is for something the company can use or resell, mean the distinct goods or services, it should be treated as expense or asset purchase for the entity. If the payment doesn't involve receiving a distinct goods or service, the consideration is subtracted from the revenue recognized. Okay, so let me give you the example here, then you will be understand in a better way. You see here, a company offered $100 discount on a future purchase if the customer buy a product today. So the discount is not an exchange for the goods and services, but reduce the amount of revenue the company recognized on the sale. So this means the future purchase, the consideration, you see the entity is paying to the customer. If reducing, they want to give discount if they purchase in the future. So this means that they will not receive any distinct goods or services. So that should be subtracted from the amount of revenue. Now if the company pay customer $500 in marketing services like advertising or promotion, so that will be considered as this is a purchase transaction, because the company will receive the marketing services and that should be treated as an expense. Okay, so for distinct goods or services, that will be accounting as a purchase. For non-distinct goods or services, that should be deducted from the purchase transaction. Clear? Okay, here we have example, and that is that how much revenue should be recognized by the Golden Gate in the year ended 31st December 2001. Golden Gate entered into contract, okay, fine, with a major chain of retail store. The customer commit to buy at least 20 million of product over the next 12 million. Now the term of the contract required the Golden Gate to make the payment of $1 million to compensate the customer for the changes it will need to make to its retail store to accommodate the product. This means that there is consideration payable to customer. The term of the contract was that the Golden Gate means the entity to make payment of 1 million to compensate the customer. So this 1 million means that consideration payable to the customer. Now you have to understand, you have to identify that is whether for the distinct good or services or not. If yes, then it will be your purchase consideration. It may be expense or asset. If not, then it will reduce the transaction price. Clear? Now by 31st December 2001, it has transferred product with a sale revenue of 4 million to the customer. Clear? Now there is Golden Gate is entered into contract with a major retail chain for a minimum purchase of 20 million. Let me explain here. Okay, they have just entered for 20 million worth of product over 12 months. Clear? Now Golden Gate is required to make 1 million payment to the customer to compensate for the store modification and net exchange for distinct goods and services. If you see here, this says in the question that 1 million compensate to customer to changes mean modification make to its retail store. So in this, for this 1 million, the Golden Gate will not receive any distinct good or services. Okay, they will not receive any distinct good or services, and that should be deducted, reduce the transaction price. Clear? Okay, fine. Now by 31st December, the Golden Gate has transferred the product with a sale value of $4 million to the customer. Clear? So if you see here, the nature of the payment is the 1 million payment made by the Golden Gate is not in exchange for the distributor services. Therefore, this payment must be treated as a reduction of the transaction price, not a separate purchase. Clear? So the transaction price adjustment, you see here that the total contract value is at least 20 million, and the payment of 1 million represent how much? If you see here, that will be 1 million, 1 million divided by 20, it will be your 5%. So the payment of 1 million represents 5%. This represent 5% of the total transaction price. Clear? So therefore the transaction price of each product sold is reduced by 5%. Clear? So the revenue recognition, so Golden Gate, revenue recognition. The Golden Gate has transferred the product of $4 million by 31st December 2001. Okay. Now the adjusted transaction price for this product is 95% by reduced by 5% multiplied by 4 million, because reduction due to the 1 million payment, and then you will have 3.8 million. So it will be, the 4 million will be reduced by 5% because this 1 million payment is not for distinct goods or services. So the revenue recognized by the Golden Gate for the year in 31st December 2001 will be 3.8. Clear? I hope you will understand. You have understand the 4 different scenario, that 4 factor that you have to consider during determining the transaction price. Okay, I think what we have done till now. Where is it? Here. We have already discussed about the variable consideration, then we have discussed that significant financing figure, also discussed non-cash consideration, and now we have just done this one, consideration payable to the customer. So when you are considering the transaction price, then you have also to consider the key factor will determine the transaction price. Clear? Now let's move on. We have another one that another step that is called allocation. Allocating the transaction price. Allocating the transaction price. So the total transaction price should be allocated to each performance obligation and a contract based on the stand-alone selling price. So if stand selling price is directly observable, these should be used. Otherwise, the most they must be estimated, essentially to maximize the use of observable input whenever possible. You have to use the stand-alone selling price for the performance obligation. Now, when the stand-alone selling price is should be directly observable. If not observable, then you have to estimate it, but you have tried to maximize the use of observable input to your estimation. Clear? Okay, by stand-alone selling prices is the best evidence of stand-alone selling prices is the price at which the good or services is sold separately. So by stand-alone selling prices, we means that it is the price at which the good or services is sold separately. If no observable price is available, then the stand-alone selling price must be estimated based on various methods. Number one, such as adjusted market assessment approach based on competitive pricing in the market, expected cost plus margin approach based on cost and expected profit margin, and then residual approach where the price is impaired by the subtracting the known prices of other goods or services in the bundle. Okay, so bundle discount. If the customer is offered a discount for purchasing a bundle, the discount should be allocated proportionately across the all performance obligations within the contract. So this allocation should be based on the stand-alone selling prices of the goods or services, unless there is observable evidence that suggests that the alternative allocation would be more accurate. We have example for better understanding, that is, if a customer buy a bundle, a computer and a warranty services, and the stand-alone selling price of the computer is at $800, the computer can be sold separately, and a warranty stand-alone selling price is $200. So the total stand-alone price is $1,000. Now, if $100 discount is offered for the bundle, the transaction price would be $900. The computer share of the transaction prices will be this one. Sorry, 800 is the stand-alone selling price of the computer. The total amount this one you multiply with the transaction price, then you will have this amount. This is the share of the computer in the transaction price, and then the warranty is doing the same, 200 divided by 1000, and this is the transaction price after deduction of the discount, and you will have the share of the warranty is this one. So the discount is allocated proportionately based on their individual stand-alone selling prices. The transaction price allocation depends on the stand-alone selling prices. Observable prices prioritized for the allocation. If unavailable, then estimation method are applied, and bundle discount are allocated across the performance obligation proportionately based on the stand-alone selling prices. Now let's discuss the example. Here, this example is from the Kaplan book. Okay, so as for the example, if you see here, uh, how the transaction price should be allocated to the machine and how much should be allocated to the technical support. Clear? Okay. Now a sell machine and 1 year pre-technical support for $100,000. So this is the total amount. Now the sale of the machine and the provision of the technical have been identified as separate performance obligation. Is usually sell the machine. So the stand-alone selling price of the machine is 95,000, but it has not yet started selling technical support for this machine. Is a stand-alone selling price product. Other support services offered by this attract a markup of 50%, and it is expected that technical support will cost this amount. Now we have already studied that when the contract include contract, you see in this specific scenario that the contract include two separate performance obligations. The one is the sale of the machine, and the second is the technical support, and both have identified separate performance obligation. Clear? Now the stand-alone selling prices. So for the machine, the stand-alone selling prices of the machine is 95,000 based on observable evidence. Clear? But there is no observable stand-alone selling prices for the technical support. Therefore, we need to estimate the price, but for that you have to increase or maximize the observable input. So cost of technical support, let me do it here. Cost of technical support is 20,000. Now markup on other support services is 50%. So estimated selling price of technical support will be 20,000. 1 plus this is the markup 0.50, and it will be 30,000. Clear? Now the total of the stand-alone selling price stand-alone selling price of both obligation, which, well, the first one is machine, that is 95,000. The second is technical support that we have already calculated, and it would be when you add this, it will be 125,000. Clear? Now allocating the transaction price. So the total transaction price in the question is 100,000, which include which include 20% discount. This include 20% of discount of the total 10 alone selling price, that is 125%. So when you take when you add 20% to this amount, then you will get this amount. Clear? This is the total 10 alone selling prices. Clear? So the discount allocation, if you want to calculate this 20%, is simple. This is 25,000 divided by 125 multiplied with 100, then you will get this amount, 20% percentage discount percentage. Clear? So when you are allocating the transaction price of $100,000 based on the proportion of the standard sale price, then it's very simple. Machine allocation will be 95,000, clear, multiplied by 80%, then you will have 76. And for technical support, the amount is 10 alone price is 30,000 multiplied with 80%, then you will have 25,000. So this is the discount percentage. If you deduct the discount percentage from 100 minus 20, then you will have this amount, 80%. So in conclusion, we say that the transaction price of this amount is allocated for the machine and for the technical support is 76,000 and 24,000. Clear? So the revenue recognition will be, the revenue will be recognized when or as the performance obligation are satisfied. Clear? So the machine recognized at the point is, that you see here, that usually sell the machine 95% and the sale of the machine, the provision of the technical support. So when the machine is delivered, then you have to recognize the revenue at the point of the transfer of the machine, and then technical support over a period of time simultaneously. Clear? Now let's move on. We have the last step, and that is revenue recognition. Revenue is not recognized when the customer make payment, even if non-refundable. Instead, it is recognized when is the performance. So when the performance obligation is satisfied, then you have to recognize the revenue, regardless of whether you have received the payment or not. Clear? So if you receive the payment in advance and you have not performed the obligation, the performance obligation not satisfied, then you will not recognize the revenue. Recognition recognizes revenue over time or at a appointed time. So at the start of the contract, entity must determine whether the performance obligation is satisfied over time or at time. For that, you have to follow criteria. The criteria is very simple. That criteria for recognize revenue over time. The performance obligation is considered satisfied over time if it meets any of the following criteria. Number one, the customer simultaneously receive and consume the benefit. So when the customer is receiving and consuming the benefit simultaneously, then you have to recognize the revenue over time. Mean if a customer simultaneously receiving and consuming the benefit provided by the entity, performance is at occur, so revenue should be recognized over time. For example, a cleaning services where the customer benefit is the services performed. Now the second indicator is that entity performance create or enhance an asset controlled by the customer. So if the entity performance result the creation or enhancement of asset, that the customer control it is being created or enhanced, revenue should be recognized over time. For example, a construction company building a building where the customer control the project during construction. So when the customer control the asset and the entity performance create or enhance an asset, and that asset is controlled by the customer, then that will also be the revenue recognized from that should be also over time. Then the third one is performance does not create an asset with an alternate use, mean it is of specialized feature, then entity has enforceable right to payment. So if the performance does not create an asset that can be readily used by entity elsewhere, the asset has no alternate use, then the entity has an enforceable right to payment for the work done to date. And if the customer cancels the contract, the entity still has the right of payment. The revenue should be recognized over time. For example, custom made equipment for a custom where the entity cannot sell the asset to another customer and it has the right to payment as work progresses. Recognizing revenue at a point in time. So if none of the above criteria are met, then the revenue should be recognized at a point in time when the performance obligation completed and the customer obtained control of the goods or services. For example, a sale of goods or services where revenue is recognized when the product is delivered to the customer and control is transferred. So in summary, if the performance obligation satisfied over time, meeting one of the criteria, revenue should be recognized over time. And if none of the criteria are met, then recognizing the revenue at a final time when the control of the product or service is transferred to the customer. So here we have an example. Let's do this example and then okay, here this is the example. What is the accounting treatment of the above financial statement of year ending 31st June 2001? So on 1st Jan 2001, you entered a contract with a customer to provide monthly payroll services. He charges 120,000 per year. Now you see we have to apply the knowledge that we have already studied, and I have already told you that for the year in 30th June, okay, here 2001, E would recognize revenue over time. Why? Because the payroll service is a single performance obligation and that is satisfied continuously. Okay, and this satisfies one of the criteria for recognized revenue over time, and as the customer simultaneously received, we have already studied here, customer simultaneously receive and consume the benefit, then you have to recognize the revenue over time. You have to recognize the revenue over time. So the payroll services is a single performance obligation that is satisfied continuously, means simultaneously for a period of time, so that is why you have to recognize the revenue over time in simple word. Clear?